Look, I don't care how smart you think you are. I don't care what school you went to, what your friends are doing, or what some kid on Twitter told you is going to make you rich. If you can't afford to lose it, you don't risk it, period. That's not caution. That's not being conservative. That's intelligence. That's survival. And survival is the only thing that matters when the music stops. I've been doing this for 50 years. I've seen brilliant people get wiped out. I've seen entire industries collapse. I've seen billionaires become broke because they thought they were smarter than the market. And every single time, the problem was the same. They risked what they couldn't afford to lose. They leveraged themselves into a corner. They believed their own mythology. And when the inevitable happened, when the cycle turned, when liquidity dried up, they had no way out. Zero optionality, game over. You want to know what separates the guys who make it through cycles from the guys who blow up? It's not intelligence, it's not work ethic, it's discipline. It's understanding that the worst case scenario is not theoretical, it's eventual. Markets turn, they always turn. And when they do, the only question that matters is whether you can survive long enough to see the other side. If you're levered to the hilt, if you've bet everything on one outcome, if you've risked what you cannot afford to lose, you won't make it. You'll be forced to sell at the bottom. You'll be liquidated by your lenders. You'll watch someone else buy your assets for 20 cents on the dollar and build a fortune on your corpse. That's not metaphor. That's exactly what happens. I've done it. I've been the guy buying from the guys who got too confident, too greedy, too reckless. And I'm here to tell you, stick around long enough and I'll explain where I think the next wave of forced sellers is coming from. Because there's a distortion building right now that almost nobody's paying attention to. But before we get there, you need to understand the foundation. You need to understand why this rule matters more than any other rule in investing. Let me tell you something about risk. Most people don't understand it. They think risk is volatility. They think risk is beta. They think risk is what some academic model tells them. That's garbage. Risk is the permanent loss of capital. Risk is being forced to sell when you don't want to sell. Risk is not having liquidity when you need it. Risk is putting yourself in a position where someone else controls your outcome. And the single biggest way people create that risk is by using leverage they can't support when things go wrong. Cheap money is poison. I've said this 100 times. When capital is cheap, people do stupid things. They convince themselves that because they can borrow at 3% or 4% or even 0, they should borrow as much as possible. They build models that assume everything goes right. They stress test for scenarios that are way too optimistic. They tell themselves that if things get bad, they'll just refinance, they'll just raise more capital, they'll just sell something. But here's the problem. When things get bad, everyone is trying to do the same thing at the same time. Refinancing disappears, capital markets close, buyers vanish, and if you're over-leveraged, you're done. I don't use a lot of leverage, never have. People have criticized me for it. They've said I left money on the table. They've said I could have generated higher returns. And you know what? They're right. In the short term, in a rising market, leverage amplifies returns. But I'm not playing the short-term game. I'm playing the long-term game. And in the long-term game, the guy who survives wins. The guy who can stay liquid, who can wait, who can be opportunistic when everyone else is in distress, that's the guy who builds generational wealth. The guy who swings for the fences with borrowed money might hit a home run, but eventually he strikes out. And when he does, he loses everything. This isn't theory, this is observation. I've watched it happen over and over again. The savings and loan crisis, the dot-com bust, the financial crisis. Every single time the same pattern. Easy money creates speculation. Speculation creates excess. Excess creates over-leveraging. Over-leveraging creates fragility. And when the cycle turns, fragility becomes catastrophe. The people who survive are the people who never put themselves in a position where they had to be right about timing. They structured their deals so that even if things went wrong, even if the market collapsed, even if refinancing disappeared, they could still hold on. They could still wait. they could still be buyers when everyone else was a forced seller. You know what my advantage has been? It's not that I'm smarter than other people, it's that I'm more paranoid. I assume things will go wrong. I assume the market will turn against me. I assume that whatever I think is going to happen probably won't happen exactly that way. And so I structure everything with margin for error. I don't maximize leverage. I don't optimize for the best case scenario. I optimize for survival. And survival gives you optionality. Optionality gives you the ability to be opportunistic. And opportunism is where the real money is made. Let me be clear about something. I'm not saying don't take risk. I'm saying don't take risk you can't afford. There's a massive difference. I've taken huge risks in my career. I've bet big on contrarian ideas. I've bought assets that everyone else thought were garbage. I've gone into sectors that were out of favor, that were bleeding, that were being written off, but I never bet in a way where if I was wrong, I'd be wiped out. I always kept enough liquidity to survive a downturn. I always made sure that my cost of capital was sustainable even in a stressed environment. I always maintained the ability to say no, to walk away, to wait for a better opportunity. Now that's the key. If you're over-leveraged, you lose the ability to say no. You become a forced participant. You have to transact when the market says transact, not when you want to transact. And when you're transacting on someone else's timeline, you're going to get a bad price, you're going to sell low and buy high, you're going to do exactly the opposite of what you should be doing. The guys who make money in this business are the guys who buy low and sell high. And the only way you can do that is if you have the financial flexibility to be a seller when everyone else wants to buy and a buyer when everyone else has to sell. This is why I've always been obsessed with free cash flow. I don't care what your mark to market is. I don't care what some appraiser says your asset is worth. I care whether it generates cash, because cash is what pays your debt. Cash is what gives you staying power. Cash is what allows you to wait. If you own an asset that generates strong free cash flow and you have conservative leverage, you can survive almost anything. The market can crash. Cap rates can blow out. Liquidity can disappear. And you're still okay because you're generating cash and your debt service is covered. But if you own an asset with weak cash flow and high leverage, you're in trouble the minute anything goes wrong. You're dependent on refinancing. You're dependent on asset appreciation. You're dependent on the market staying liquid. And the market doesn't care about your dependence. I'll tell you another thing. The best investments I ever made were when I was buying from guys who didn't follow this rule, guys who got over-leveraged, guys who thought the party would never end, guys who built entire businesses on the assumption that they could always roll their debt, always raise more capital, always find a greater fool. When the music stopped, those guys had to sell, and I was there to buy. I paid prices that were a fraction of replacement cost. I bought assets that would have cost twice as much to build. I took over businesses that were fundamentally sound but financially engineered into distress, and I made a fortune doing it. That's what people don't understand. Distressed investing is not about hoping for disasters. It's about recognizing that disasters are inevitable and positioning yourself to be a buyer when they happen. But you can only be a buyer if you're not also a forced seller, if you're over-leveraged, if you've risked what you can't afford to lose. You're going to be on the other side of that transaction. You're going to be the guy selling to me at a terrible price because you have no choice. Now, let me talk about what I see happening right now. We just went through a decade plus of zero interest rates, the cheapest money in human history. And what did people do with it? They levered up. They bought assets at prices that only made sense if rates stayed at zero forever. They funded businesses that only worked if capital stayed free forever. They built portfolios on the assumption that liquidity would always be there. And now rates are higher and liquidity is tighter. And all of a sudden, a lot of people are realizing they don't have enough cash flow to service their debt. They're realizing they can't refinance at attractive terms. They're realizing they're in trouble. This is not a surprise. This is completely predictable. If you borrow at 2% and your asset generates a 4% yield, you feel like a genius. But if your debt rolls and the new rate is 6%, you're losing money. And if you can't come up with more equity, if you can't find a refinancing solution, you're going to be forced to sell. And when you're forced to sell in an environment where everyone else is also trying to sell, you're going to get killed on price. I'm already seeing it. I'm seeing deals that penciled beautifully 2 years ago that are complete disasters today. I'm seeing sponsors who can't make their debt payments. I'm seeing lenders who are getting nervous. I'm seeing assets hitting the market at prices well below what people paid for them. And this is just the beginning, because a lot of this debt hasn't matured yet. A lot of people are still hoping they can make it through. But hope is not a strategy. And the guys who are hoping instead of acting are the guys who are going to get wiped out. This is where discipline matters. If you've been conservative, if you haven't over-leveraged, if you've maintained liquidity, you're in a position of strength right now. You can wait, you can be selective, you can let the distress play out and step in when assets are trading at real discounts. But if you've been aggressive, if you've maximized your leverage, if you've assumed everything would go right, you're in a position of weakness. You're fighting for survival. And survival mode is not where you make money. It's where you lose it. Let me tell you what really bothers me. It's not that people make mistakes. Everyone makes mistakes. I've made plenty. It's that people make the same mistakes over and over again. Every cycle, there's a new group of people who think they figured it out. They think they're smarter than history. They think the rules don't apply to them. They think they can time the market. They can lever up. They can play with borrowed money, and everything will be fine. And every cycle, those people get destroyed, and yet the next cycle, there's a whole new group ready to do the exact same thing. Why? Because the pain of the last cycle fades. Because new players come in who didn't experience it. Because everyone wants to believe they can get rich quick. Because leverage feels like free money when things are going up. But it's not free. It's a loan against your future optionality. And when you give up optionality, you give up control. And when you give up control, you're at the mercy of the market. And the market has no mercy. I've built my entire career on maintaining control. I don't invest in things I don't understand. I don't use structures I can't support in a downturn. I don't take risks that would require me to be perfect. I assume I'm going to be wrong some of the time. I assume markets are going to turn against me. I assume liquidity is going to dry up. And I structure everything so that even if all of that happens, I'm still okay. I can still survive. I can still play the next hand. That's what people miss. Investing is not one hand of poker. It's a lifetime of hands, and the only way you get to play a lifetime of hands is if you don't go bust on any single hand. If you risk everything on one bet, eventually you're going to lose. Maybe not today, maybe not this year. But eventually the odds will catch up to you, and when they do, you're done. No second chances, no do-overs. You're out of the game. I don't want to be out of the game. I want to be in the game for as long as possible, because the longer I'm in the game, the more opportunities I see, the more cycles I live through, the more distressed situations I can take advantage of. And the only way I stay in the game is by never risking what I can't afford to lose. Now, here's what I promised you. Here's where I think the next major opportunity is forming. And it's not where people are looking. Everyone's obsessed with office real estate, with regional banks, with commercial mortgages. And yes, there's distress there, but that's obvious. That's in the headlines. That's what everyone's talking about. What almost nobody is talking about is the private equity overhang. You've got trillions of dollars of capital that was deployed in the last 5 years at valuations that don't make sense anymore. You've got portfolio companies that were bought at 15 times EBITDA that are probably worth 10 times today. You've got funds that are coming to the end of their life and need to return capital to LPs. You've got sponsors who are sitting on unrealized losses and praying for a recovery that might not come. and you've got a refinancing wall where a massive amount of private equity-backed debt is going to mature in the next 2 to 3 years in an environment where debt is expensive and lenders are cautious. That's the distortion. That's where the forced sellers are going to come from. Not just real estate, corporate assets, operating businesses, entire portfolios, and the guys who have liquidity, who have been patient, who haven't risked what they can't afford to lose, are going to have the opportunity to buy quality businesses at discounts they haven't seen in over a decade. But you can only do that if you're still standing. If you've blown yourself up chasing returns, if you've over-leveraged trying to keep up with benchmarks, if you've risked capital you couldn't afford to lose because you were afraid of missing out, you won't be there for this. You'll be on the sidelines. Or worse, you'll be one of the forced sellers. So here's my advice. Stop chasing. Stop trying to maximize every basis point of return. Stop listening to people who tell you that conservative means leaving money on the table. Conservative means staying in the game. And staying in the game is everything. Focus on free cash flow. Focus on assets you understand. Focus on capital structures you can support in a downturn. Build in margin for error. Maintain liquidity. And for God's sake, never risk what you cannot afford to lose. If you want to think like an owner instead of a speculator, if you want to build wealth that lasts instead of returns that evaporate, if you want to be the guy buying at the bottom instead of selling at the bottom, then subscribe, hit like, and leave your investment thesis in the comments. Tell me where you think the opportunity is. Tell me what you're worried about. I'll try to give you an honest answer, even if it's uncomfortable, especially if it's uncomfortable, because the truth is what matters, not what you want to hear, not what makes you feel good, the truth, and the truth is simple. Never risk what you cannot afford to lose. Lo,